Okay, good morning, everyone. We'll start it up. Okay. All right, last night's session in the U.S. was a strong one. Obviously, up over 1% on the S&P and on the NASDAQ. Dow didn't quite make the 1% number, but that kind of completes the same sort of scenario that we've seen. I believe it's 14 out of the last 19 trading days we've moved 1+% on the S&P. I think that's significant. Funnily enough, here locally, it's felt like we haven't had any volatility for the last week. But when you look at that kind of statistic, I mean that we didn't see a 1% move for the longest period in like 20 years, or maybe it was longer last year at one point. So that change. The change in volatility is definitely there, but I think there's been so much volatility, more volatility in the States that it's been, we're kind of starting to get used to it a little bit. So yeah, another 1% plus move there in the States. I think that our local markets kind of been consolidating for a breakout very much the way that the U.S. has as of recent. If you look at some of the moves that we saw yesterday, we saw dramatic moves lower in light sweet crude. We were down about 5%, I believe, yesterday. A lot of those names under pressure. You could see that Halliburton came out. They said they're going to cut their workforce by about 6,500 people, 6 to 8% of the entire workforce. So that's obviously significant. Coca-Cola jumped about 3% after earnings were better than expectations. But other than that, I think that the real reason why we rallied was simply Greece. The rumor that Greece and the Eurozone have come to some accord and that they are actually going to be able to reach some sort of agreement where, I personally think that the market's still being very optimistic about this. I mean, when you look at the rhetoric out of the Greek finance minister, the guy's aggressive, and he's really talking very, very drastically about negotiating, and I think that the market probably should be a little bit more hesitant than it is, but it is what it is, and the markets managed to trade up nicely yesterday off the rumors that they're getting closer to an agreement. All right, overnight we had no real follow through out of the Asian markets. We had Shanghai, which was up again. Somehow continuing to manage to move higher. KOSPI also up. Hang Seng was down about 0.75%. In Australia, down a little bit over 0.5%. Mining stocks got hammered yesterday in London. So I think that there's a little bit of that was probably follow through on the back of yesterday's trade action in Europe. We had Nikkei was actually closed for a public holiday, but the Hang Seng kind of underperformed, I guess, relative to what everything else did. If you look at our chart of interest on the day, chart here from Morgan Stanley showing the Chinese overall debt percentage to GDP. Now this to me is one of the most scary things that's out there at the moment. No one's talking about this. You've had since 2007 to 2014, you've had debt to GDP, debt to GDP, which has risen by over 100%, and that's happened during what was a bull market, what essentially was good times in China, and that's what's so scary about this. This chart right here just proves to you that the only reason why China has been doing even half of what it's been doing is that the government's been pumping so much money into the economy to keep everything going, and it's impossible for them to continue to maintain this. I believe, if I'm not mistaken, these guys are literally have out of nowhere become the highest in the world. I mean, you go down all the way back, only 20 years, not even 20 years ago, you were under 100% of GDP. You were literally at 245% debt to GDP, and you can see where the breakdown of this is. Non-financial corporate just through the roof. government also through the roof, and that doesn't even include the shadow banking system there. So when you hear, how bearish I've been on the China space, this is why. There's a real problem looming here. How can they get aggressive? How can they come in and start to do stimulus? They've already freaking been throwing stimulus the whole time, and that's what the market doesn't understand. That's why I think it's lower for longer in the commodity space. I'm talking about book now, but that is, I think, that chart right there says it all in a nutshell. All right, this morning we had CEPI out with first quarter numbers, headline earnings per share looking a touch better, revenue looking quite light actually, so however that works, maybe a one-off in there. Group 5 looking a little bit light from guidance, also looking a little bit, or maybe I should say quite light on revenue numbers. The full year revenue numbers are supposed to be at 1587, so it's really hard to put that into context of where the revenue numbers are for the first half. Divi per share also looking light there. Asor we're expecting today as well. We've got Pepsi, MetLife, and Cisco Systems in the States today also. All right, if we look at the market data today, very little on the cards, all out of the States. NBA mortgage apps, crude oil inventories, which I think is going to be a big one to watch, and the U.S. monthly budget statement. Okay, let's get into the maps. First thing that we'll have a look at will be Cecil. Shorten this up a touch. You can see here Cecil really is entered into a little bit of a narrowing wedge here that I think over the past, call it 6 or 7 sessions, I think that once we break out of that, we will probably see our next significant move. It's been an incredible rally off of the lows, considering the lack of substantial rally out of the oil market. But a very strong move here in the States. There's been enormous buying. We did 1.5 million shares in the U.S. again. At the very end of the session, they just pumped through enormous volumes almost on a daily basis. I think until the buying that's happening right now in the U.S. market, which we never see volumes even half that size, until that volume starts to dry up a little bit, it looks like the share will probably be supported rather well. Right. Looking at SA Breweries here, so there's a level. I mean, if you look at this level on a bigger chart on the 2-year, this is quite a big level here, just north of 630. I'd throw it out at 635 here. You can see, and that really pretty much runs all the way across. It still looks a little bit head and shoulderish in the big picture, but I think it doesn't trade that way. If you could see this thing getting above this level here, 635, then I think we've got a nice breakout coming and a very significant breakout. So I would peg that level at 635. If we get above 635, then I think we've got probably as much as 30 Rand upside in SA Breweries. All right, next one I'll look at is Barlow World. The rudder put me onto this one this morning. If you go back and you look, I mean, we're all the way at a 5-year chart here, but if you look at us on the trend line here, it's quite compelling. You can see very clearly that we dropped trend support the other day, and let's just zoom it way forward. You can see that we came up and we tested trend support, or trend what was support now becomes resistance. And yesterday we had quite a significant reversal off of these levels. So this one is very much attached to the China story from my point of view, and I think that it's starting to look a little bit like a bear flag. Could see lower levels potentially out of Barlow here. And keeping it short again today, only 4 charts. Look at Mondi real quick on trading statement from yesterday. We had a nice breakout of really what's been kind of a rising channel of consolidation. We finally broke out of that. We've been doing that for maybe the past 10 sessions. We finally popped out the top of that yesterday and getting closer to the target from the breakout of that we got out of the last 2 years or year plus of consolidation here when we broke out at about $200. And that's it for today, guys. Good luck out there.